Michelle Bowman, who is a contender for the Federal Reserve seat that Jerome Powell holds, just gave us some commentary. And boy, there's a lot of commentary around jobs and what she sees in terms of emergency relief and the responsibility of the Federal Reserve in response to this emergency relief. We got to talk about exactly what she just said. Shout out, by the way, Tesla. On our Meet Kevin Alpha report this morning, we called the 414 bounce. We've been calling for days that we were going to 414. We bounced off 414, and guess what we did this morning? Turned bullish on Tesla, baby. Let's go. 414 bounce. Got the Cybertruck shirt on because of it. So, what does Bowman tell us? Well, obviously...
Coupon code expiring soon.
It's linked below. It's at meetkevin.com. Okay, Fed Bowman says, recent data show a materially more fragile labor market, with inflation ex tariffs hovering not far above target. So she's basically saying, hey, we're like a little above target on inflation, but, quote, there is materially more fragility in the labor market. That's a big red flag. She says the time for the FOMC to act decisively and proactively to address the decreasing labor market dynamism is now, and that there are emerging signs of fragility. She is a full-on dove here, which is great. This is actually exactly what Donald Trump is looking for. So it's unclear how much of this is her sort of applying for the job for Fed chairperson or Fed chairwoman. Anyway, he's like so used to saying Chairman Powell, right? But anyway, right now markets are pricing in now 2 full cuts by my birthday, January 28th, 2026. As of this morning, we were actually only at like 1.8 cuts priced in. So we've actually moved up on fully pricing in those 3 cuts, the one we just got, and then 2 more by January 28th birthday. I'll be an even number of years, so it's going to be a good year next year. This year's been good too. Not that there's anything wrong with odd numbers, not to offend the odds, you know. But anyway, Michelle Bowman says recent data, including benchmark payroll revisions, show we are at serious risk of already being behind the curve. Her words, not mine. Serious risk of being behind the curve. We need to act proactively. The labor market dynamics are decreasing. There are increasing signs of labor market fragility, and tariffs aren't really showing a lot of inflation yet. We're just a wee bit above inflation target. Get over it, and let's get rates down. Again, Waller is calling for 150 basis points of cuts. He wants the Fed chair job. Bowman is calling for, we're behind the curve, we need to get ahead. And Myron's calling for 250 basis points of cuts. So, well, we're getting us to 250 basis points. So I guess that'd be more like 150 basis points of cuts, which is only about a quarter more than Waller puts us at. Anyway, these are the 3 people circulating to get us down in rates. And all 3 of them want the Fed chair job. Anyway, Bowman then goes on to say, the economy may be experiencing an extended period of a productivity surge from recent tech advances, aka artificial intelligence. He says she expects inflation to return to 2% after a one-time adjustment from tariffs. She says the shift is appropriate for forecasters to widely expect inflation to significantly decline next year. Wow, she is just basically talking straight into Trump's playbook here. The economy may be inflexible, and we have to be careful that if we look at backward-looking data, we actually end up guaranteeing that we remain behind the curve. And so we should stop overweighting the backward-looking data points and move to a proactive forward-looking approach. We should also, during good times, think about having the smallest balance sheet possible. So that way, when there is more market stress, we can respond to that market during emergency situations, basically with money printing. So she's kind of like, honestly, a little bit of a bearish. It's kind of like part dovish, part bearish, right? Because on one hand, you've got her like, hey, we're going to run the money printer if there's a crisis. And hey, we're behind the curve. We need a cut. Like, we got to hurry up and cut. And at the same time, she's like, hey, the labor market is well, I mean, let's just use her word, materially more fragile, and we are behind the curve with decreasing labor market dynamism, and inflation's going to decline significantly next year. So let's get off of this and actually start like getting these cuts going. Okay. Well, this is pretty dovish. It's helping push rate cut expectations to 3 by January 28th, a little later than expected, but it's keeping that 10-year at about 4.18, just under that 4.2 resistance right now. So still a little bit of a challenging environment to hope to get those rate cuts priced in sooner, but Bowman's definitely pushing hard here, and she could be right. She also says that she sees slower population growth and aging population as more prominent factors pulling down the neutral rate, basically saying that we might actually have to cut lower than we think, because when we have an older population and slower population growth, we end up being in more of like a Japan kind of situation where you have slow growth outside of AI, and we'll probably end up having to have lower rates than ever before. Now, that's been a projection that I made back in 2022. In 2022, I said that by 2032, rates will be lower than ever before. That's why, and by that I mean like, under 2.5% 30-year mortgages. A lot of people hear that right now like that, you're out of your mind, dude. The 30 years at like 6% right now. There's no way. It's going to happen. I'm extremely confident of it. Not only am I extremely confident of it, but I'm putting my money where my mouth is, because in our Meet Kevin membership, we're doing 10 stocks to buy over the next 10 years with this understanding already built in, this expectation of rates going in that direction over the long term. And so she's actually reiterating that, suggesting that we're going to end up pulling down the neutral rate. The neutral rate, if it was 2.5% before, where we have to be under that to, stimulate, the neutral rate might only be, 2% or 1.5%. She also suggests that emergency lending facilities should be limited to one-time use, situations. So emergency cases, basically. In other words, like don't print money all the time. That's basically a slam on, kind of a slam on Bernanke on QE infinity, like constant quantitative easing. And that kind of rings to exactly what the Trumpian, administration wants to hear. You don't want to hear somebody who's like, oh yeah, we're going to run up the nation's debt by printing all this money and having it reflected in treasury bonds and treasury accounts. But we are going to advocate for lower rates. So she's kind of talking out of both sides, going, yeah. In good times, we need to get rates down. By the way, we're behind the curve. We need to get rates down now. In good times, we need to get the balance sheet down, right? That talks up to Trump. But right now, we need to focus on how the labor market is decaying. The neutral rate is probably lower. We probably need to get rates down way lower than we've ever thought before. Well, sort of aligns with Kevin's 10-year vision that we launched in 2022. Mind you, I like, this should not surprise you, okay? Like, if it surprises you that Kevin's talking about rates being lower than ever before in 2032 and how he made this prediction in 2022, it's a 10-year prediction, right? So it's not like I'm patting myself on the back going, yeah, I was right. I'm trying to say, like, that could still play out. It's still unpopular to say that today, and I really think it's going to play out. Like, everything's lining up for that to play out. It's actually exactly why I created House Hack the same damn year. See, I figured it would take me a good 6 to 8 years, worst case, give me 10 years, to build House Hack into, what I think could be a multi-billion-dollar enterprise, especially, once our AI launches in Q4. I mean, that could rocket us to multi-billion very, very rapidly. No guarantees, obviously. I'm biased as the CEO. I'm really excited about our AI product, but we haven't launched the beta yet. That comes in Q4. So we're really excited about that. But even just from a housing point of view, we want as much housing as possible where we build housing supply, provide housing supply for people, and we own and control it. Because if we do have lower rates in 2032, and I'm telling you this now as a heads up, so you could be like, start thinking about that yourself too. I think when rates get lower than they've ever been before, the people who are going to be the most well off are the people who own the most assets. Real estate being a big one of those. Yeah, I mean, stocks obviously to some part as well. But this is an interesting speech from Bowman. Now, Bloomberg actually didn't include but a fraction of the detail that I just read to you, because I read it from her speech. And so they talk about maintaining the smallest balance sheet. They talk about her being a candidate. They talk about maybe we sell mortgage-backed securities. That's more like to get the balance sheet down. But right now, she's a dove. So you've got Bowman, Waller, and Myron, who are huge doves. And so one of them, could be going for fetch here. I don't think Kevin Warsh is the best choice. And I think Hassett is a wet blanket. I think you've got 3 great people here on the board that are all in alignment with we got to get rates down to make sure that we stop this slowdown in employment. We need employment to start rising again. Like this talk about justifying these weak unemployment numbers because of immigration, we're below break even. I mean, Powell said that at the presser, the FOMC presser, and he reiterated it afterwards. So it's a big red flag. The labor market is in the pooper doopers, and we got to get it going again. The best way to do it, cut, baby, cut. Stop the backwards data dependence and start dipping some forward.
Data dependent.
Sir. And then we can all be excited about really big
PP.
Who doesn't love that? That's my take. Anyway, okay, cool. So that gives us a little bit of a heads up on the Fed.
Knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.